Okay, so we are now in a position to actually consider a more general version of this problem, which is to construct an optimal portfolio consisting of two risky assets and one safe asset. We'll see that the insights from our previous two studies, namely the one consisting of the portfolio of one risky asset and one risk-free asset, as well as a portfolio of two risky assets, the insights that we gain from there are going to be very helpful in actually coming up with a solution to this problem. So before we get into that, let's first think of a more big picture view of what is going on. So the general investment decision can be viewed as a process which consists of two steps. So one involves capital allocation, which is deciding how much money to invest in the risk-free asset versus how much money to invest in a risky portfolio. So namely a portfolio consisting of risky assets. And then you have the second step, which is about how do you do asset allocation in the risky portfolio across different risky assets. So these two parts have two different purposes. The capital allocation process basically determines how much risk the investors have. Okay. And the optimal capital allocation therefore depends on the risk aversion of the individual as well as the expectations for the risk return trade-off of the optimal risky portfolio. The asset allocation process, on the other hand, mainly focuses on identifying the optimal risky portfolio, namely the combination of risky assets that provides the best risk return trade-off. So to understand these points, it is useful to consider an example. And what we'll do here is just continue with our example two as before, except for now, instead of just looking at these two risky assets D and E, which we have been considering from before, we are going to also actually bring in a risk-free asset, which is offering a rate of return of 5%. So let us first understand the basic points through this diagram, and then we'll get into the more analytical details. So in this diagram, we have expected return on the y-axis and standard deviation of returns on the x-axis. We have the two risky assets, D and E, which we have studied before using exactly the same parametric values as in example 2 outlined here. And we have here this blue curve tells us what are the feasible combinations that we can get if we just combine the two assets D and E in a portfolio. So this is something that we had studied before in our second example. Now, what we are bringing in is, in addition, a risk-free asset, which gives us a return of 5%. So this is the assets position here. Notice that the y-axis in our particular picture begins from actually 5 and not 0, right? This is just for making the picture more convenient. So we have got one asset here. We have got these different risky assets that are here. The question is, now we want to combine this risk-free asset with one of these risky assets. What's the best asset to actually go ahead and do the combination with? So perhaps the most plausible candidate that one can think of is that why don't we consider asset portfolio A, which is actually the minimum variance portfolio that we had considered. However, if we notice, this is actually equivalent to a problem where we have studied before, right? Namely, the problem involving combining one risk-free asset with one risky portfolio. And remember that when we had a choice between whether to combine it with a risky portfolio A or whether to combine it with a risky portfolio B, we figured out that actually what we should be looking at is which one gives us the higher value of the slope of the line connecting the risk-free asset versus this, right? This is exactly the discussion that we had before, where namely we concluded that what we should be looking at is to figure out which portfolio has the highest Sharpe ratio, right? So let's look at the numbers. And but before we do that, basically, when we are to link it to our discussion with capital allocation. So when we are optimizing the capital allocation, remember, capital allocation is the division between the risky portfolio and the risk-free asset. What we want to do is we want to work with the capital allocation line, which offers the highest slope or the Sharpe ratio. This is again a conclusion that we had got when we had studied a portfolio consisting of one risky asset and one safe asset. The steeper the capital allocation line, the better it is. And we can see from here why that is the case, right? Because if you observe the capital allocation line corresponding to portfolio A and portfolio B, we can see that the one corresponding to portfolio B is steeper and it is actually better, right? Why? Because for the same standard deviation, it is offering a higher expected return. And hence, if there was a choice between choosing to be on capital allocation line A versus capital allocation line B, most people would actually end up choosing the one on B, right? Uh, so that's the capital allocation. Now the asset allocation part involves figuring out what's the actually the best risk portfolio to choose, right? Here we compared A and B, but maybe there are all these other portfolios to consider on this blue curve. Which one is actually the best, right? So that part is the asset allocation problem, right? And we'll see that the solution is going to be the portfolio that maximizes the Sharpe ratio is the solution to the asset allocation problem. Okay. So let's just first compare this A and B. So remember, portfolio A is the minimum variance portfolio that we calculated before, and recall that it had a weight of 82% on the debt and 18% on the equity asset. And based on these numbers, we can actually back up what's the portfolio's A's expected return, which is 8.90%, standard deviation 11.45%, and therefore the Sharpe ratio, right? Remember, Sharpe ratio is the difference between the expected return minus the risk-free return divided by the standard deviation. So that here comes down to approximately 0.34. Now, if you consider another portfolio which has 70% on debt and a weight of 30% on equity, and then if you back out the numbers, this is basically this portfolio B that we see here. What we find is that that will give an expected return of 9.50% and a standard deviation of 11.70%, right? So if you calculate the Sharpe ratio, we can see that this is approximately 0.38, and therefore it's better than the Sharpe ratio compared to portfolio A, right? So if we had a choice of combining the risk-free asset with this portfolio B versus portfolio A, clearly portfolio B is better, right? So this is the first part. But then one can start thinking that, okay, clearly B is better than A. So definitely, if this is the only two choices we had, we should go with B combined with the risk-free asset. But maybe there are these other feasible portfolios that are on this blue curve that are even, in fact, better, right? So what's the best thing that we can do? And the answer to that is basically to identify what is the tangency portfolio. Okay, so this is also known as the optimal risky portfolio. And this is basically that portfolio which gives the capital allocation line with the highest slope. Okay, so for each portfolio, actually connect it with the risk-free rate and then figure out which one is the one giving the highest portfolio, right? So this is the actually the optimal risky portfolio to mix with the risk-free asset. Okay, so this is how we do it. And graphically, it's pretty clear. So what you do is that you have this curve, which is what we have already kind of figured out, the different combinations that you have by combining D and E, what are the corresponding expected returns and standard deviations. So start from the risk-free rate and figure out the tangency point to this curve, and that will give you the one with the highest slope, right? Okay. So how do we go about doing it analytically? So the objective is basically to find a weight WD that results in the highest slope of the capital allocation line. So basically here the objective function is the Sharpe ratio, which for a portfolio P is given by expected return of the portfolio minus the risk-free rate divided by the standard deviation of the portfolio return, right? Now, if we have got portfolio with two assets, the expected return is given by the weighted average of the expected return of the underlying assets. And here we can actually, for the numbers that we have, the expected return of the debt, remember, was 8%, and the one for the equity asset was 13%. So this is how the expected return of the portfolio would look like. This is the general formula for the standard deviation of a portfolio of assets consisting of two assets, right? And here again, if you plug in the parametric values that are given, these are the numbers that you have. So just one point to note, this sigma D is actually 0.12. This was incorrectly stated before, right? So in the example that we have studied before, as well as here, the sigma D is actually 0.18, 0.12. Okay, so these are again the numbers, and so therefore the optimization problem is you want to choose WD to maximize this Sharpe ratio for portfolio P, where we have the expression for expectation of RP in terms of WD, as well as sigma b in terms of WD. So we can plug all this in, and we can see that now this is a function of some things which are just parameters to us, and the only choice variable is WD. So this is a more complicated optimization problem than before. I encourage you to work it out, but essentially the general solution is given by this expression that you see here. So W star D is going to be expectation of capital RD. So where capital RD is the return minus the risk-free rate for the debt, and capital RE is the return minus the return of the equity minus the risk-free rate. Okay. And so therefore, what we get is that this is the expression that you see here, right? So just a couple of points in this expression. So one thing is that why are we writing it in terms of capital RD, which is equal to RD minus RF rather than RD? Well, we could have written it down in terms of RD as well. This is just a bit cleaner notation here, okay? And this capital RD, which is basically the rate of return minus the risk-free rate, is what is known as excess return of the debt. And capital RE, which is the rate of return of the equity asset minus the risk-free rate, is what is known as the excess return of the equity asset. Okay. Excess in the sense that this is the return that it is getting above the risk-free rate. And this is the expression that you get. Okay. So let's see how to use this in this particular example. So we have basically, remember, value of RD. So this is what we had, 0.08, and RE was 0.13. So therefore, this capital RD's expected value of capital RD is 0.03, and the expected value of RE is 0.08, right? So we had expectation of RD and expectation of RE, which we are incorporating here. We had values of sigma E and sigma D, which we are incorporating here. And covariance of RD-RE is going to be the same as covariance of small RD-RE, right? Why? Because this RF is just a constant, right? So these two covariances are basically the same. And that's how you end up getting this expression. And so therefore, if you do the calculation, it turns out that W star D is equal to 0.4. So what that means is that the tangency portfolio has 40% of the portfolio in the debt asset class and 60% in the equity asset class. So we can also calculate what's the expected return of the portfolio P and the standard deviation and Sharpe ratio. These are just things that you would want to put in here. So WD you would put in 0.4. And here again, you put in WD equal to 0.4. So you get an expression for expected return and the standard deviation of return. So that comes down to 11%, and standard deviation is 14.2%. And the Sharpe ratio you can calculate on the basis of these numbers. So that's approximately 0.42. Now, this is not the end of the problem, because this just solves one part of the problem, which is that what is the optimal risky portfolio? But we want to find out what's the optimal complete portfolio, in the sense that we want to say that given a certain amount of money that we have, how much to invest in the risk-free asset, how much to invest in the equity class, and how much to invest in the debt class, right? So the next step actually requires us to actually think about what's the optimal complete portfolio, given the optimal risky portfolio that we found and the capital allocation line generated by a combination of this optimal risky portfolio and the risk-free rate, right? And this is where we incorporate the investor's degree of risk aversion. So notice this important point. When we were determining the optimal risky portfolio, we didn't anywhere use what is the investor's risk preference, right? So this is because regardless of whatever the investor's preference is, we want to be as high as on this capital allocation line as possible, right? So in the sense that we want to have the line with the highest slope of the capital allocation line, independent of whatever the investor's risk aversion is, right? Now, how much to invest in actually risk-free asset versus the risky asset? That is where the investor's risk aversion comes in. So here, basically, we are back to the problem of you have got a certain amount of money, you are deciding how much to put in the risk-free asset versus how much to put in the risky asset. The risky asset here is basically this optimal risky asset that we found. Okay. So let then W star denote the weight on this tangency portfolio or the optimal risky portfolio. Then we get that from our previous expression that W star is equal to expectation of RP minus RF divided by A sigma square P, right? Remember, this is the expression that we had derived when we had looked at our study of the choice of allocation of money between one risky asset and one risk-free asset. Now, for A equal to 4, which is the example what we had before, we can actually figure out what W star is going to be. Remember that for our optimal risky portfolio, expected return is 11%, the standard deviation is 14.2%. We can put in these numbers, and the risk-free rate was 5%. So therefore, W star is approximately going to be equal to 0.7439. And therefore, we can basically say that we are going to be investing 74.39% of the money in the tangency or the optimal, the risky portfolio. And the remaining amount, which is 25.61%, we are going to be putting in the risk-free asset. Now, this amount that we are putting in the risky portfolio, that is going to be divided between bonds and equity. So the percentage of the portfolio, this is the overall portfolio that is going to be invested in bonds, is going to be equal to 0.7439 multiplied by 40%, so 29.76%. And the percentage of portfolio in equity is going to be 0.7439 into 60%, or 44.63%. So that's how we end up with a complete description. And this is a graphical view of what is going on. So again, just to complete our description, so we had basically one risk-free asset, which is represented here on this point, which is 5% that you see here. We had another asset D and a third asset E. Okay, so D and E are risky assets in the sense that their standard deviation is not equal to 0, right? And we can also see that E basically has higher standard deviation, so it's more risky, but it also has a higher expected return compared to D, and obviously compared to that of the risk-free asset as well. Now, the first step is we actually figure out what are the different points that are possible by combining different points of this D and E, right? And then what we did is that we used the risk-free asset to think about what's the optimal risky portfolio to do, right? So this is this tangency portfolio that we found, which again you find by maximizing the Sharpe ratio, right? And till this point, there is no discussion of how risk averse an individual is, right? That comes in the second part, when once we have figured out what's the optimal risky portfolio, and therefore we have determined what's the capital allocation line corresponding to this portfolio, we incorporate in the individual's preferences, which is represented here through this indifference curve, and the tangency point is going to give us the optimal complete portfolio. And on the basis of this, we can actually figure out about how much of the portfolio is to be invested across these three different assets. So just one thing to note, that one area that we have abstracted away from is that when we started out by saying these two assets as debt and equity, there was already one layer of optimization that had been done to construct these asset classes, right? Because you can think about equity basically means shares of different companies, right? But there's no just one single share, right? So you have got these different shares that you could have combined to figure out what's the optimal equity asset class, right? And similarly, you could have done the same thing with regards to different bonds issued by different entities, companies, and so on, and think about what's the optimal debt class, right? So already in this picture, we have abstracted away from that just to focus on these different aspects of portfolio optimization. But that's the third layer of basically optimization that you are doing within each asset class. So again, that's something to consider when you are doing this full optimization problem. And that is something we leave for a more advanced course on investments, right? So the next step is to actually generalize this insight of this portfolio allocation problem of two risky assets and one safe asset into some general insights that we can give for general and risky assets, right? So that is coming up in our next segment.